Well, hey everyone. Welcome to Chart This with Dave Keller. It's Thursday, July 10th. So glad you're joining me here for the show. Those of you that are joining live as we live stream on Facebook, LinkedIn, YouTube, and X, so appreciate you doing so. I'm able to see questions and comments that you put on any of those platforms during the live stream. Please put them on there. Any questions that come up during the course of the show, we'd love to answer a question or two at the end of the episode. Any of the questions we do not get to, we will put in the mailbag. We're planning an all mailbag episode tomorrow on Friday, July 11th, and we would love to answer one of your questions there. We're going to get to the market recap here in a few moments. Great week on the podcast so far. My interview with Victor Hagani, just got that back from the editor. I was hoping to get it out before the episode started here today, but wasn't able to do it. I'm going to work on it afterwards, so look for that here later this evening. Victor was one of the founding partners of long-term capital management, has had a successful career in the financial industry, now a money manager, trying to instill good money management and decision-making techniques with a focus on bet sizing, which ended up being a big part of our conversation. I think that's a must listen to. Some really good tips and takeaways from that. Also earlier today, really good interview with Adrian Zadunchik. Adrian is a early crypto pioneer. He is the founder of a crypto community called the Bird Nest, which runs out of his home in Poland, as well as other parts around Europe and the Middle East. We talked all about crypto. I had a list of questions that I would love to ask an expert like Adrian about Bitcoin dominance, the practical value of Bitcoin, cyclicality and seasonality in cryptocurrencies, the bull case, the bear case, being a contrarian, being a trend follower, and so many other great questions that I thought Adrian answered beautifully. So a lot of good information, especially if you're less familiar with cryptocurrencies and it's still sort of an opaque market. Hopefully a lot of questions answered about all things crypto. So good episodes coming out. Keep an eye on our YouTube channel. We're also now on all the podcasting platforms like Spotify, Apple Podcasts, and wherever else you get your podcast awesomeness. With that in mind, let's talk about the markets today, and you will see kind of a choppy day here. Excuse me. It's sort of interesting, by the way, as we go through it. While the S&P was up, what's noticeable to me immediately is the fact that the NASDAQ underperformed. What's also noticeable to me, as you'll see in a moment, is that the two worst performing sectors today were communication services and technology, aka the juice off the April lows. What we'll also see when we look at the market carpet, a bunch of technology stocks down multiple percents, 3-4% today plus, and some charts flashing some bearish divergences. Almost a leadership rotation type of feel to today's session. I always caution people to draw too many long-term conclusions from short-term data, right? Things like we see today, you need to see multiple days of that sort of rotation to really declare a major change. But it's certainly noticeable to me that the S&P today looked generally a lot stronger than the NASDAQ composite, and something certainly to continue to watch. While we're on the front page here, and the NASDAQ was basically almost flat for the day, we can see that small cap S&P 600 up about 1%. We talked about small cap outperformance on yesterday's show. Continuing that trend today with small over large being the story. That has not been the story for most of 2025. Arguably most of the last couple of years, small caps have generally been underperforming, but we're starting to see more and more days like this. Now, having said that, even though some technology and communication names sold off a bit, you can see that the VIX continues to drift lower. So this is one of those low volatility bull market phases. Prices trending higher on lower volatility. That's what a bull market looks like. So what's great is, what's easy about this is I would argue you follow that uptrend until the picture changes. And this is why, to be honest, I started doing a show years ago. It's because it helps me selfishly to track the evidence every day. And I force myself to look at the same charts and to highlight some key themes every trading day. And I hope it encourages you in your own process to think about what you would need to see between now and some very negative rotation for risk assets, what that chart would look like, how it would be reflected on the set of charts that you watch. Are you watching the right warning signs? And I would argue things like volatility, measures of breadth, measures of momentum, definitely where I would be focusing my attention. We'll highlight some of those charts here on today's show. But for now, VIX still saying nothing to worry about, right? Low volatility. That means a low risk at this particular moment. Pretty good, I would say pretty successful treasury auction today. That's one of those, it's usually kind of a nothing burger of an event. A treasury auction is one of those kind of boring maintenance kind of go through the motions type of things. But more recently, it's been important because as investors have been, sort of questioning at times US dominance and maybe thinking that the age of U.S. financial dominance relative to other assets or other global markets maybe starting to unwind. A lack of interest in treasury bonds would be one of the ways to measure a lot of skepticism. Excuse me. We actually saw a pretty decent auction, pretty decent appetite for debt. The TLT ended up being flat for the day, up 0.1%. Rates generally were fairly stable. The 10-year point kind of ended where it started, around 435. The long bond yield just below 4.9%. The 5-year point just above 3.9%. Dollar index slightly higher. Not a huge day, to be honest with you, I would say, fixed income wise. Looking at the commodity space, yesterday we highlighted silver over gold. We talked about that as a general kind of pairs trade and how silver has really started to differentiate itself. And here today we have another of the same. Look at today's action in the GLD, basically flat until 2:30 p.m. Eastern, and then a bit of a rally into the close. Compare that to silver, which looked like that all day. So this idea that precious metals are just a thing and it doesn't matter what you own in that space, not really the case here. I'm seeing silver as a much better technical setup than gold, and much stronger uptrend than we're seeing with gold. So something to consider if you've been on the gold trade, as I have for a while now. Maybe it's a time to diversify into other precious metals, demonstrating a little more strength than gold. Crude oil price is slightly lower. You can see the USO, which is a crude oil ETF, was down about 2% today. Natural gas prices were up. Copper continued an uptrend today after rallying yesterday. Kind of a news-driven announcement there, and up another 1.5% today. Crypto space, I mentioned my interview with Adrian Zadunchik. Hopefully we'll get that out to you tomorrow. If not early over the weekend. But we talked a lot about the chart of Bitcoin, making new all-time highs today, currently trading just above almost to 114,000 for the first time in history. That's up about 2%. Ether prices around 28.25. That's up 2% as well. Most of the top 10 coins here up today. My conversation, to give you a preview, he's actually a lot less bullish than I thought he would be. And that was one of the reasons why I wanted to invite him on, because we talked about how from a seasonal perspective, Bitcoin actually can be a little weaker in the coming months. From a longer term perspective, he saw a lot of, just too much euphoria, so much widespread optimism about cryptocurrencies. It's becoming a little more mainstream. In his opinion, sort of that big, huge upswing from early adopters may be nearing the end. And he's talked about actually lightening up his Bitcoin exposure. I'll save the rest of that for his. Those are his thoughts and not my own. So I'll let him articulate his reasoning and thinking and why. I do still own positions in Bitcoin and Ethereum. All right, looking at the 11 S&P sectors, pretty decent update. 9 out of the 11 sectors up, which on the surface seems pretty awesome. The bad news is the 2 sectors that were down, technology and communication services, 2 of the biggest sectors, and certainly 2 of the strongest sectors in 2025. So what you look for in this sort of environment where the market has been rallying pretty consistently off of the April low, and we've had a set of leadership themes, right? Technology as the most dominant sector by far, and then other strength in things like industrials, communication services kind of hanging in there pretty well. But then most of the other sectors have been underperforming here over the last 6 to 8 weeks. You look for a change. You look for days like this where technology starts to lag. But it's not a one-day thing. You look for that, multiple days. You look for, that as more of a recurring pattern. And when that happens, that indicates more of a rotation where investors are really starting to rotate assets from things that have been doing very well, like technology, to maybe things that have been doing less well, like utilities, like healthcare, and other things that are appearing a little higher on the leaderboard today. The XLY consumer discretionary ended up being your top performer, up just over 1%. Utilities number 2 and energy number 3, those are both up about 0.8%. Looking at the breadth conditions, another pretty good day here, right? I mean, if you look at the New York Stock Exchange, a 2-to-1 ratio, stocks up versus down, with 65% of the New York Stock Exchange listings finish in the green. That's pretty decent. S&P 500, 70% of the index was up. So, again, while you have some big names pulling back a bit, the general trend here remains quite strong. Another thing to look for when I mentioned earlier, breadth. Look for the market to go higher, but for these breadth readings to shift, right? And if you start to see general positive weeks with days of opposite, of kind of negative breadth, where this heat map is more in the reddish colors, that would be a big red flag. We're not seeing that. We're seeing the market drifting higher on decent breadth readings, which is a sign of a bullish trend. So prices going higher is bullish. Breadth being constructive is bullish. So look for those things to change. Volatility being low at this point in the cycle, pretty bullish. So look for a change there. We're going to get to airlines. I forget if I grabbed one of those charts. I don't think I did actually. So we might grab one off the heat map today. But we had earnings in the airline space. It was pretty good. So the top 3 performers in the S&P are all airlines: United, Delta, Southwest. Your top 3 performing S&P 500 names. It's been a while since I've been able to say that here on Chart This with Dave Keller. All right. Looking at the Magnificent Seven and Friends, this is a series of leading mega cap growth stocks. Tesla, the top performer, up almost 5% today. Don't get me wrong, that chart is still not great, and we're coming off of some pretty beaten down levels, but a decent up day on a stock that has been struggling. Nvidia up 0.8%, Apple up 0.6%. On the downside, Netflix down 3%, which I also did not grab. We might look at that one here in a moment. But Netflix down about 3%. Broadcom down slightly as well. We'll look at the heat map in a second. I'm gonna cut the corner here and go right to Netflix though, because I think it's an important chart to watch. While we talk about Netflix, as a reminder, I'm watching the questions and comments coming in. I appreciate you asking questions as we go. We'll take a question or two at the end, and the remaining questions will go into the mailbag. We've had some fantastic questions from you guys this week. I can't thank you enough. It gives me some great things to talk about, some interesting themes to dig into a little deeper. I promise you, I try to read every comment that comes in on any of these platforms and on social media as well. It's ended up being an important part of how I understand what you guys are thinking about and looking for, and thinking about how I can make the show more relevant. So if there's something you have on the top of your mind as a question, please put it in there. I guarantee I'll see it. I can't guarantee I'll answer them because I get more questions than I have time to answer, but I would love to take a look for sure. So Netflix, someone actually mentioned that Netflix had broken below its chandelier exit. That was a question that came through just a few moments ago when I saw it. That's not where that is. It's here. Okay, chandelier exit. I was going to talk about chandelier exits a little bit lower. And Tabby, thank you for watching on YouTube and dropping the question as a shout out. I appreciate it. As we're looking at this, to be true, to be clear, 100% right. I mean, you can see the chandelier exit is basically a trailing stop that is built on average true range. That is, in my experience, traders that I've worked with that I think really do a fantastic job of managing risk tend to use volatility as a main input in stops, right? A simplistic way of doing it, which is still good. I mean, a stop loss process, even an imperfect one, is better than none. So have an exit strategy. And the most basic one is like a percent, right? So if I buy a stock, if we go 8% below my entry point or 10% or whatever that number is, you close out. And all that does is it limits your losses to 8% or 10%. You just know you're not going to lose more. It might whipsaw you and you might miss the next big upswing, but it's going to prevent climactic loss, which I would argue is a big part of the game as a trader. But it's not a very nuanced, dynamic way of measuring stops, because some stocks are just more volatile than others, right? So for some stocks, an 8% move could be a huge move. And for other stocks, an 8% move could be kind of a normal day or two. So average true range is a much better way of thinking about stops because it adjusts the stop based on the volatility of the stock. So if the volatility is normally pretty high, the stops are naturally going to be wider. And if the volatility is very low, then stops naturally going to be tighter. That's a better way of sort of understanding normal price action versus when your stop is triggered. So having said that, chandelier exit system, which was popularized by Dr. Alexander Elder in his books. One of my favorite ways of just using average true range as a way of just having a good initial stop, right? And the general idea is when a stock like Netflix is going up, you're fine until and unless we break below the stop, which it looks like we're actually doing today here. We did close slightly below it. On a move like this, to be honest with you, I would always look for the next day to see if there's a follow through day, which for me is just a basic question of, do we continue down? Because a lot of times what happens, you'll have like an initial break and then buyers will come in and you'll just pop right back up. So we trade a little bit lower tomorrow, and I think that clears the way to suggest that stop was triggered. But Netflix actually actively hitting that level. We're not going to go through the chandelier exit system on every stock out there, but it's worth noting that we're seeing those sorts of names break those sorts of levels, and it's starting to happen in certain areas. All right, let's look at the heat map here, and I just wanted to comment that a couple observations as I was looking earlier this afternoon. Number one, obviously a generally pretty decent day, and we'll ignore the upper left, which is the technology sector to start, but we'll look elsewhere. A lot of things to like, right? And it's not just Tesla going up. I mean, within consumer discretionary, you've got gambling names like MGM and Caesars starting to break out. CZR pushing above $30, $31. Clearing the May peak is not a bad thing. MGM popping higher as well. It's up about 3%, continuing the breakout above 35. We've got cruise lines doing well, like Norwegian up over 5%, Royal Caribbean making new 52-week highs today. And so there are a number of names in the consumer space looking pretty good. Within healthcare, names like Charles River and others starting to show signs of accumulation, starting to break higher. Within the so still in the consumer discretionary sector, we highlighted, I think yesterday, home builders. But like DR Horton breaking to 140. I wrote an article for CNBC Pro earlier today about the home builder ETF ITB, looking at a couple different technical setups within the home builder space, and again, pretty constructive action, clear signs of accumulation. That's something that's become more and more clear, I think, as the month of July has progressed. What does not look particularly good at a high level looking at the heat map? Well, the big red Netflix kind of immediately jumped off as I was looking at this chart earlier today. Netflix, obviously a bit of a downside outlier today within communication services, but also within the S&P 500, kind of one of the worst movers today. Also noting the big box retailers like Walmart, which has now failed with a drop below 100. Costco failing to get back above 1,000. It's very interesting to me that both Walmart and Costco are testing big round numbers. $100 a share for Walmart, Costco at $1,000 a share on an adjusted basis. Those stocks don't hold those big round numbers. That's just not a good sign for the stocks themselves, but also I would say for broader risk appetites. These are some names that have done quite well at times prior, but not looking as strong today. But the big story, to be honest with you, on top of all of those things, is all the red that you see in the technology sector, right? ServiceNow, Salesforce, Accenture, Palo Alto, Fortinet, CrowdStrike. A number of these names are down 4 or 5% today. And while not all of them are horrible charts yet, some of them are starting to be not great. I mean, at very least, they're going from great to good, and if not from good to not so good. And I would argue that is a warning sign you look for, is a change in leadership, right? There's a certain configuration that has allowed our major benchmarks to appreciate so much from an April low to where we're at in mid-July. And technology has been arguably the biggest story, right? On a relative basis, the technology sector outshines all the others in terms of consistent outperformance. Now, it's still doing okay here, even with today's drop, but this is noticeable to me that there's a lot of little red boxes in the technology sector in a way that we've not seen a lot since the April market low. So more of that over time starts to make technology less of an obvious outlier on the positive side, and more like an opportunity to rotate into other things that are starting to emerge. Those are some takeaways looking at the heat map. And again, big fan of this. I would encourage you to use features like Market Carpet on stock charts. Other platforms have heat maps like this, things that allow you to go macro to micro all on one page. I'm a huge fan of that. And I love the way that it helps you make sense of the markets on multiple levels. All right, let's get to some charts here to finish off the show. We'll take a question or two. We'll call it an evening, and go from there. The S&P 500 obviously continued to go higher. We did slightly make a new intraday all-time high today. We did not make a new high on a closing basis, but we're right about there. The S&P finished today around 6280 in an undeniable uptrend. So, as a contrarian, there's a lot of reasons why we could cite as to why the market should not go much further. But from a trend following perspective, I don't think you can define this market as being in anything but a clear uptrend. And what makes it an uptrend? Higher highs and higher lows, upward sloping moving averages, strong momentum. These are all characteristics of charts in accumulation phases. And I think the S&P is showing all of that. So what would tell us things are different? What would tell us to be concerned? One thing we're not really seeing yet that is always a potential issue, bearish divergences. We did highlight that in June, which is one of the warning signs we saw in going into mid-June, which made us feel like maybe that was the beginning of a drop to lower levels. Higher highs May and June, lower peaks in momentum. That was negated by the market moving to new highs on stronger momentum. So it sort of eliminated that divergence. What you would look for here is another divergence, right? New highs marked by weaker momentum. I would argue these most recent new highs are marked by pretty decent upside momentum. I think this is a chart doing pretty well. So divergence would be one thing. I don't think we're seeing that yet, but something to look for. The 21-day EMA has been a really good short-term, stop for pullbacks. That happened in May, that happened in June. So if we do get a downside rotation, I'll be looking right at the 21-day EMA. And as long as that holds, things just aren't that bad. That starts to break, we need to think about whether it's the beginning of something a little bit further. So those are two kind of obvious things I would be looking for. I'm not seeing either of those yet. I'm seeing the S&P still in a clear uptrend phase. Quick check on sentiment here. We won't spend a ton of time on this, but the weekly sentiment data we like to follow comes out on Thursday. So the AAII survey is a weekly survey of individual investors. Curious if anyone watching the show actually participates in the AAII survey. Let me know at the comment if you do. I'm just curious. I don't. I've actually thought about it at times, but I've got enough to worry about, I guess, on an average trading day. But it's a weekly survey. They literally survey their members. And one of the great benefits is it's been going on for so long that you can go back through deeper market history and see how the survey has evolved over time. For where we're at right now, we actually did downtick a bit this week. So bulls down to around 41%, bears increasing slightly to around 36%. That means we're still net bullish, but just slightly less than we were last week. This rotating to bulls outnumbering bears, that had not been the case for most of 2025. Last week, we actually saw a final swing to the bullish side as bulls finally outnumbered bears. Looking back, that's more what bullish phases tend to look like. But when you get extreme bullish readings, that's when you can often get a bit of a pullback here. Now that is where that survey ended up. The name exposure index actually dropped quite a bit this week. Last week it was at 99%, almost to 100% allocation to equities. This is a group of money managers that answer the question of what their allocation is to the equity markets every week. Went down this week around 24% to 86%. Now, that's still a little higher than average when you look across the long-term averages in the survey, but down quite a bit from last week. So money managers in this survey kind of fading this week's rally, or I guess getting a little skeptical after the severe uptrend we had last week. I mentioned the interview on the Market Misbehavior podcast. Hopefully we'll get that out to you shortly. Talking about Bitcoin. For what it's worth, Bitcoin continuing to move to new all-time highs. Today, powering above 113,000 for the first time. We'll see if it's able to sustain this breakout. But for now, Bitcoin remains in a primary uptrend, higher highs and higher lows. Again, what you look for in this sort of environment, I would argue your goal should be follow trends as long as possible. That's what I'll be doing. There are a number of ways you can determine when a trend like this might be over. Moving averages are one of my favorite ways to do that. Trend line analysis can be super helpful. So just, the simple exercise of drawing a trend line off of the major lows, that gives you, just a visual representation of the pace of this uptrend. That was the most poorly drawn trend line in the history of chart this. Well, it's doing something a little weird. Hold on. I'll have to mess with this after. Yeah, something's weird with how I'm drawing this trend line. I'll have to fix that after. But drawing a trend line off of the major lows and then just using that as a trend following tool and just tracking the uptrend to see, if that trend line holds. That's another way to kind of think of it. But in any case, however you're measuring it, Bitcoin back to overbought territory, above trend lines, above moving averages, still bullish for now. All right, let's talk about some of the technology charts. I mentioned on the market carpet a number of things starting to break down a little bit. I mean, Intuit is still not a horrible chart. I mean, it's still arguably still a pretty good chart, coming off of a new all-time high at the end of last month. But for the last couple weeks, we can see rotating lower. And today, trading below the 21-day EMA for the first time since April. You have to go back to the April low for the last time that Intuit was below its 21-day EMA. We broke it today. Now, what concerns me more than that is a clear bearish divergence, right? Higher highs early June into late June, weaker momentum reading. So today's drop comes after that indication of weaker momentum on the most recent move to new highs. Something to watch there. ServiceNow is another stock in the technology sector, in the software group, testing the 200-day moving average today. Now, on a day like today, we're closing just below the 200-day. This is where I would look tomorrow to see if we hold that and get a bounce off of the 200-day or not. The last time we tested the 200-day was last month. We had a nice bounce, ended up making a new swing high, but now we're kind of rotating back to that level. And the RSI is right at 40. So if this goes just slightly below the current levels tomorrow going into the weekend, then we have a breakdown of the 200-day on weaker momentum, which would be a really negative sign on a former high-flying name, ServiceNow. Palo Alto Networks, little different in that it's been attempting to break to new all-time highs. You go back to December of last year, you find the last time we went above around 205. We retested that level at the February peaks. It ended up being kind of a double top pattern before the April low. We round tripped back to that level, but now we've spent a couple weeks failing to get above there. So this is less of a breakdown name, although it did break both the 21-day and 50-day moving averages just on today's session. So it's pretty severe sell-up, almost 7% lower. But this is coming after failed breakouts, right? An inability to break to new highs. CrowdStrike is similar to one of the previous charts, I think, Intuit, and then we have a bearish momentum divergence. It got below the 21-day EMA, which drew my attention, down about 5% today, but I'm concerned with the higher highs in price on weaker momentum in RSI. So I think that's certainly a story to be watching into tomorrow's session, into next week. Some of the declines we're seeing in technology, particularly some of these software names. And if that continues, that really could represent a change of tides where, the best sector, arguably, I mean, I don't think you can argue it. I mean, clearly the best sector in 2025 has been technology. Is there a question mark a bit on that dominance? We'll see. So while technology is rotating lower, you've got things like home builders breaking out. I mentioned the article I wrote for CNBC Pro about the ITB. This is one of the charts that we talked about looking at improvements in volume. Look at all the up days on heavy volume that we've had here in the month of July. Accumulation distribution trending higher. Chaikin money flow consistently above zero. These are volume-based indicators. Basically, that the strong up days are good. That's what causes the price to go higher. But the improving volume indicators show how the volume that we're seeing on those up days is pretty strong, right? A bullish trend is usually marked by big up days on heavier volume as big institutions start to accumulate meaningful shares. And the chart is telling you that that's the play we're seeing in the home builder space. All right, I already kind of talked about chandelier exits. Royal Caribbean's another one. When I had a question on this one about, what do you do in this environment? My answer is you become a just very patient trend follower. This is the kind of chart, if you're sitting on gains in a Royal Caribbean, I'm not a huge fan of selling just because it's up a lot. I mean, I get the argument. And if you want to start unwinding positions because it's overvalued and overextended, plenty of people try to do that. And I don't want to say that that's wrong. It's just certainly not how I think of it. And the reason is because earlier in my career, I would just love to sell way too early, sell when something was up 25%, and then just sit there in agony as the stock would go up 50%, 100%, and I just sold way too early. So the way you get away from that is to become a trend follower. And if you own a position that's working well, this is where Peter Lynch would say you water your flowers, right? You nurture that position and follow it up. Things like the chandelier exit, I feel, are great ways of locking in gains as they continue, helping you identify some places where you may want to start to lighten up. But it's less because we've gone up a lot. It's more that you're starting to see some initial signs of distribution. So it's an indicator I find helpful in this particular type of environment. We highlighted this one last chart of the day, Delta Airlines. We highlighted it at the end of yesterday's show because earnings were coming today. And the question is, do we get the breakout that would confirm a bull flag pattern? The answer was yes. And here you can see that today's gap higher, Delta was up about 12%. Some of the other airlines up even more today. As we highlighted earlier, I would say today's price gap completes that breakout above the bull flag pattern, also completes a move above the 200-day moving average. Let's see if that holds going into the weekend. But for now, nice upside follow through. We talked about that potential setup. It looks like today's earnings completing the rotation to the upside. Bitcoin up to 116,000 as we're doing the show here. It's trending higher as we go. Let's take a question or two here. Boy, a lot of really good questions. I really can't tell you how much I appreciate that. Those of you tuning in live. Someone asked about year-end targets. Boy, I am not a fan of year-end targets kind of things. When pressed in like I'm on CNBC and I get asked, like I'll answer it because you have to, and you can't say I don't know. You have to answer something, so I will have an answer. But I'm not a fan. I will tell you because as a trend follower, having a target for the S&P or Royal Caribbean or something like that, I find those just incredibly meaningless as time goes on. I would much rather define the trend and identify what's working and stay with that as long as possible. And whether the S&P goes to 6,500 or 7,500, if the trend's still bullish, I'm going to want to still own the S&P that whole time, right? As long as my market trend model remains positive. So I will respectfully decline, Sean, your question about year-end targets. Others will boldly go ahead and do that. Those, honestly, I mean, in my experience, I will say my cynical view, those are great headlines that definitely brokers will use to to get headlines, to get their name out there and get their word out there. And I don't blame them for doing that. In terms of the practical value, I found them not particularly helpful, which is why I won't play the game. All right, let me get an actual question I will answer here. Ooh. Merdrad, I will take a stab at pronouncing your name. Thank you so much for watching on YouTube. I appreciate it. Do you prefer the industrial sector or the technology sector, and why? I love this question because a version of this question is something we would do all the time in my Fidelity years. Big fan of these questions, the A/B discussion, right? So many times you're looking at a particular stock and you think the question you're asking is basically, should I own this or not, right? That's the question. But comparative analysis, thinking about which of these two or which of these three names gives me the best opportunity right now, that is one of the great benefits you have if you trade equities or ETFs, because there's always something else you could consider, right? It's not just about, trading Russell E-mini futures and, do I own it or not? As an equity investor, it's like, should I own this stock or this one over here? Do I own a life sciences company or a Japanese bank or a Brazilian oil company? And charts allow you to make that comparison on an apples to apples basis in a way that a fundamental analyst would struggle to do, because the businesses are just too different and the themes are just too diverse. But charts bring them all together in a very consistent way, which is one of the great benefits to our toolkit. So that was a long-winded way of saying I love your question and thanks for asking it. So what would I prefer? I mean, ideally, I wouldn't have to choose, but given the choice, and I will bring up, where am I going to bring this up? I'm going to go to my monthly chart review. We just did a monthly chart review for our premium members earlier this month. This is the set of charts that I go through every month, talk about some longer term themes. I'm going to use this set of charts because what it does is it applies my market trend model to a series of relative performance measurements. So this is looking at the relative performance of technology versus the S&P. And this might be a familiar chart if you followed my work, because this is my market trend model that I run all the time on the S&P. I also run it on different ETFs, different asset classes, and the relative performance of sectors, where I found it actually to be quite helpful. Now, technology has been the strongest sector. So if you look at the relative performance, all time frames, the market trend model is bullish on that relative strength. Now, if I run the same thing on the industrial sector, It's just turning back bullish on the short term, but it has been bullish on the long term and the medium term. So these are two of only three sectors out of the 11 where the medium term model, which is the main one that I use for my own portfolio, that they're bullish. The rest of them, the other eight sectors, are all negative. The only three that are positive are technology, industrials, and communication services. So I would say you're picking two of the stronger sectors. So I mean, I think there's a big jump from technology or industrials down to everything else. I mean, a noticeable gap. Having said that, if I had to pick one, I'd probably pick industrials here. And the reason is, kind of some of the stuff that we've seen here. When I look at the industrial sector, I'm seeing stocks emerge from bases. I'm seeing stocks start to break out. I'm seeing, airlines as an example of a theme that had not been working that is starting to work. And right now I'm seeing in technology, while there are still some obviously very good charts, like in semiconductors, I'm seeing a lot of things start to break down. So, the danger with buying technology and not industrials is you're buying something that's already had an incredible run and you're not buying the thing that probably is still emerging. And I'd much rather probably take the other side of that at this particular moment. That might end up being the wrong call, but I think that's what I would be doing right about now. Other question, Sean, you said, can RRG be used for day trading or week trading? I love that. I would probably wouldn't use the term week trading, but I think I know what you mean. I would tend to think of it as, in terms of different time frames you can trade on. Day trading is sort of like, 1 day or less. I mean, really looking at intraday exits and entrances. I would say the week time frame is really more swing trading, which is looking over a series of days or weeks and being able to hold positions overnight and looking for those short-term swings. Both of those, you're talking about mean reversion, right? So you're talking about buying weakness and selling strength. That's the general approach that kind of works. Position trading, longer term trading, is where trend following is much more effective. And that's what I do in my own portfolio. Having said that, I've spent a lot of time working with traders who are more swing traders and looking at shorter term timeframes. Can you use RRG for those timeframes? You definitely can. Do I do it often? I do not, just because that's not how I trade. But if you do, you should check it out. I usually start with a weekly RRG. But if you go to the upper right, there are intraday versions, right? So you can look at a 5-minute RRG. You can look at an hourly RRG. And this is on stock charts, other platforms where RRG is available. You should check to see what the capabilities are. I've used it on Optima, which is pretty powerful there. Using RRG on intraday timeframes is really meant to help you identify short-term swings. And when something like technology gets overextended on the tactical time frame, maybe rotating lower, where you would find it here in the leading quadrant, starting to rotate down. And again, by using some of those short-term time frames, you can start to really understand rotation within day-to-day and even week-to-week time frame. So for sure, what you want to do is just make sure you dial that period down to a period of time. And I think it's going to be a little bit of a try, I'm missing what I'm trying to say. Trial and error is what I'm trying to get to, of just seeing which timeframes, which periods work the best for what you're trying to do. But I would definitely encourage you to explore RRG. And Julius DeKempeter does some really good work for Stock Charts TV, the YouTube channel. I don't know how much he's talked about some of those intraday timeframes, but I would send him a request to do more of it if that's something you're looking for. Folks, that'll do it for today's show. Really awesome questions. Thanks, guys, that are tuning in live and asking questions. Really appreciate it. I didn't get to all of them. I'll put the rest in the mailbag. Look for an all mailbag episode tomorrow for Chart This. Also, keep an eye peeled on my YouTube channel for the latest episodes of the Market Misbehavior podcast. Victor Hagani should be coming out to you after the show. Adrian Zadunchik tomorrow or Saturday. And great guests again in the weeks to come. For Market Misbehavior, I'm Dave Keller. Have an awesome night. Remember, it's always a good time to own good charts. Take care, folks.